What's up, YouTube? We're going to go over Verizon, ticker symbol VZ. Um, Over the course of the 1 year, down 24%, year to date, down 17%. Um, the- Verizon reported earnings just shy of a month ago. They missed on their revenue, and they beat on their bottom line there. Um, One thing to keep in mind here as we're going through the valuations on Verizon to figure out a fair market value, keep in mind of the market cap of $139 billion. So we'll hop over here. We're going to start going through the valuations here. We're going to start with Peter Lynch valuation. We got our ticker symbol VZ. We have only future EPS growth of 2%, and honestly, that's kind of on the high side. Dividend yield is 7.86%, which is really good. Forward revenue growth of only 1% going in the next 12 months for analyst expectations, which then gives us only a Peter Lynch fair value of $10 per share. And we come over here, we have our PEG. Current PEG today is 6.64, forward-looking PEG 7.07. We had our multiples comparison. We T-Mobile, or sorry, AT&T is not on here because they're not profitable right now. So we only can use T-Mobile, and I've got Charter here, and gives us a comps of $99 per share. Graham's valuation, everything autofills over here. We get our growth rate projection of 2%. Corporate current yields on corporate bonds is 5.16. Gives us an intrinsic value of $44.77. Market cap. Here's that market cap, right? $139 billion. Cash and cash equivalents 4.8, debt 1 point or 164 billion, 36 billion cash from operations, gives us an 8 multiple before this equals its market cap valuation. So 8 years it'll take this company to grow to equal its current market cap if nothing changes, which currently not going to by the looks of it. Return on invested capital, actually better than I would have expected, but 10%. I like to see this 15% or better. Price to book down here, total assets, total assets that they have is $380 billion. There's $40 billion of intangibles. Total liabilities, 232 billion. Outstanding shares, 4.2 billion shares. Price to book per share, 25. Price to book ratio, 1.3. So this company currently is almost valued like dollar for dollar, which, I mean, you're going to overpay, but you're also going to get a dividend. I mean, you're barely overpaying, but you're also going to get almost an 8% dividend on this company. So typed in all of these numbers. Again, here's our market cap. Our market cap is less than, actually, our market cap of 1.3 or $139 billion is almost 3 times less than our total assets on this company. Okay, so I think this is where things get weird. So total debt, $232 billion. Market cap is only $139 billion. Gives us a weighted average cost of capital of 2.55%, which is the lowest I think I've ever seen. Anyway, we'll come over here. Free cash flow. I typed in all their free cash flow over the course of the last 5-6 years there. And we've got our weighted average cost of capital that comes over here, 2.55%, perpetual growth rate, 2.5%, forward free cash flow growth rate of 2%. Analysts have it at 0. Average growth rate was 27.5%. Now this autofills based on all these numbers here and gives us a terminal value of $33 billion in the next 5 years. And then the sum of free cash flow, future free cash flow from here to there. And then we type in our current cash and marketable securities, which is $4.8 billion. Our debt, which is $232 billion. And then that gives us our equity value of 28 trillion. All right, so I paused the video there for a second, and I wanted to change something that I didn't realize is so this weighted average cost of capital is 2.55%. So I was like, okay, it's the lowest I've ever seen, but all these numbers are right. I went through their balance sheet. That's the numbers. So then I Googled. I'm like, okay, what is the current weighted average cost of capital? It's 3.73% on here. So I'm like, okay, well, I'm not far off. So then I put that, or sorry, I didn't even bother changing that. I was just going to leave it the same, but we can change it to 3.73%. And then what I did was I took the perpetual growth rate and took that away completely. So even if I put that back in at 2.5% and then a growth rate of 2%, it gives us a DCF of $207 per share, which still seems, significantly elevated. So let's come back and put back the 2.55 with no perpetual growth rate and no free cash flow growth rate. This is just a company. There's no growth coming. This company on this sheet, if it continues to produce a free cash flow of where it's at right now, this company is worth $74 a share. Verizon on the 72 rule, we have earnings per share, and then our lowest EPS growth rate was 2%. So we come over here. 5 goes into 72, 36 times. 36 times goes into 10 years, only 0.27 times. So I gave it a future EPS of 7. So with 7, it gives us a fair market value of only $7 and then $49 right there. Or sorry, $4.90 per share. The stock chart here real quick and take a look and see where she's trading. So currently trading about $35 a share, $33, or yeah, not 35, $33 per share here. There's this since 1984, I believe. 84. This company's been trading obviously in this upward channel overall. Currently trading at the lower side of this bottom side of this channel. You can probably move these lines however you want. I originally think I had it something like this because then I got more bottoms included into this channel. Either way, it appears as though, you could do this too, I suppose, but then you're only lining up 2 or 3 bottoms, whereas here I'm lining up multiple bottoms. So looking based on this technical chart here, I think Verizon currently is at the bottom of bottom of the channel. I think Verizon has every bit of legroom to come back up to the top of this channel of 43, maybe 46, $48 a share. And then our valuation method here, it gives us 38 to 55. So let's be conservative. Let's say that's what it is. Let's say $38 per share and $55 is an average fair market price. That lines up with the technical still. Right now it's underneath our 30% margin of safety, and it probably won't see 55 anytime soon, but either way, there's still $10 to $12 of upside, really. Yes, this can go lower, but you're looking at the price to book, you're looking at all these valuations. This company is undervalued and you get almost an 8% dividend. So like it's a pretty good deal. I like Verizon. I think this is a pretty good area to start picking up some shares, and maybe as Verizon starts trending higher, you maybe want to get rid of some of those shares, or you just kind of hang on because you're in it for an 8% dividend. That's really good. And this company that doesn't appear to be going anywhere because its free cash flow is $14 billion a year. It's got plenty of cash. It's not hurting, and it looks pretty good to me. But that's it for Verizon. Let me know down below what you guys think of Verizon. What are your plans with Verizon? Are you going to buy Verizon, or are you selling Verizon? Um, Also, if there's any other companies you want valued, just put those in the comments down below. Also, if you would subscribe and like the video, that'd be awesome. But that's it. And we'll be back tomorrow with more.